Hi everyone, welcome to the latest market update and outlook video from Heartwood Financial Services. Hey, this market has been doing pretty well. Last month we had a little bit of a hiccup. We'll talk about what's going on there. But going forward, what is going to keep this market going? What needs to happen for the market to continue the strength that it's had so far year to date, in spite of everything going on geopolitically? So if you want to find out more, stay tuned. Let's go. All right, let's get started with the asset class returns for the month of July. The green is July, the blue is year to date. And so as you can see here, it looked like a pretty boring month. Actually, there was a lot going on. The market was actually down pretty good going into the last few days of the month, and then it had a couple really good days right at the end that helped save the S&P from going negative. It was just barely flat. Huge divergence though. We're seeing some of the financials, healthcare stocks do really well, and the tech stocks take a pretty good hit for the month. So that was interesting. Maybe a little correction, maybe a new trend. We'll have to keep an eye on that. Small caps were down pretty good. They didn't get as much of that lift right at the end of the month, so they took a little backseat. I think interest rates going up hurt small caps a little bit more. Real estate did pretty good. Usually they're a little bit more interest rate sensitive too, but real estate continues to be kind of a defensive asset class, so it's been doing pretty well. Pretty good year. International stocks struggled. We saw actually the dollar go up quite a bit, so that might have been one of the reasons, but we also have, more of an uptick in the geopolitical stuff. So that's been bad for international markets more than us here, because we're talking about Iran and oil prices and all that. So developed market was down, emerging market down even a little bit more. We talked about how tech took a pretty good hit. Emerging markets has actually a lot of tech, especially in South Korea where they got a lot of those memory chips, big part of their stock market. So that took a pause. So that was down. The fixed income markets were down a little bit, but not a big move. We'll talk a lot more about that in the outlook about what's going on with interest rates, why they went up. And is that a cautionary sign for inflation and the Fed and all that? But the winner again was commodities. This is why I've been holding this little piece of commodities in the portfolio, kind of like insurance. This is where you have gold and oil and all these other commodities. Gold actually hadn't been doing very well. And the month of July was actually down. So this was mostly all energy. We saw the turmoil with what's going on in the Strait of Hormuz. So oil prices came back up, commodity prices back up. All right, so let's talk about what's going on with the economy, how that looks, and a couple points about what's to come. All right, let's kickstart the market update with what's going on with inflation. As you can see here by the chart, we actually had a drop in inflation for the month of July. It's technically for the month of June. It just comes out in July. So that's the downside with these inflation measures. There's so much going on. By the time you get the information, it's a little stale. Because we did see prices of oil go down in June, which is why we had a nice drop in the PCE headline number, a minus 0.1 for the month, which we were anticipating a positive number, so that was good. And the core, which excludes food and energy, so it's supposed to be a little bit more stable, only went up 0.1, so we're at 3.3 for the core. And again, that's the one that the Fed really is focused on looking at the most. And it really hasn't been going up very much. And actually just ticked up just a little bit, so that's a good sign. The downside, though, is we all know what happened in July. We had oil prices go up dramatically. I think it was in the 20-something% range. So July is going to probably see a little bit of an uptick, but we'll have to see how much it really affected the core, because that's really what the Fed looks at to see where the trends are going forward. The stuff with oil, it comes and goes and changes by the day, so it's kind of hard to set their policy based on just that. So that core is really what they're trying to get down to, that 2% level. All right, there was a Fed meeting. It was actually in August, right at the beginning of August, so I slipped it in to this July update. But you would look at it and say, no change. Well, that's not very exciting. Why are you even talking about this deal? Well, it was actually pretty interesting. Kevin Warsh's only his second meeting. The media was grilling him pretty good. He has a very different style from Jay Powell. He doesn't want to give a lot of what's called forward guidance, where the Fed would actually say like what they thought the interest rates would be, quite a bit down the road. He doesn't like doing that. He thought that it was too much information, and it actually was creating a little bit of a codependency kind of thing, which you think about it, it's actually maybe true. But anyways, so they kept the Fed funds rate the same. 3.5 to 3.75 is where we're at with the Fed funds rate. It was a 9-3 vote, 3 dissenters. So that was pretty interesting, more than you normally see. So you're starting to see, I think some disagreements inside the Fed. They're fighting about what to do. The 3 dissenters were for rate hikes. So this whole notion of lowering interest rates, which what Trump wanted, doesn't seem like it's going to have an easy path, especially with inflation being a little higher. We just talked about it. The fact that it went down, I think, helped, but it's still pretty high. Now, before today, which I'm filming this on Friday, there was a 58% expected rate hike in September, which is the next meeting. And what's interesting is the jobs numbers came out today. We'll talk about that in the big three. I'm not going to spoil it right now. It actually reduced the probability of a rate hike into like the high 30s. It was a pretty dramatic change. And this is interesting because the market was throwing a little bit of a hissy fit about how Warsh was not as open about talking about what they were going to do down the road, and just his communication style was a little different. So the market was kind of throwing a little bit of a hissy fit. We're going to talk about that and the outlook with what happened to interest rates. But I think after today, you're starting to see that the Fed probably did the right thing. All right, so here's the big three report where we talk about how the manufacturing economy is doing, the services economy, and the employment numbers. All right, so these are huge indicators of also how things are coming down the pike. So with the manufacturing numbers, again, another solid number at 55.6. Remember, anything over 50 is a growing number. So this is a very strong number. Manufacturing actually really hasn't been very good up to until the last few months, and then it's been very strong. So that's a wonderful thing to see. A lot of that is probably the AI build out, which we've been talking about a little bit here on this channel. The ISM services PMI was also up at 54.1, so just barely squeaked a little higher than last month, and again over 50 nicely. So that was also very good to see. So the economy there looks pretty strong, but then today we got this really weird report. Doesn't seem to jive with everything else we're looking at. The unemployment report, or the employment report from BLS, it showed a negative 23,000 jobs. Last month, it was 57,000, and that was actually really low because the previous month before that was over 100,000. So something's definitely going on there. So this is something to keep an eye on. This is one of the reasons why you saw the likelihood of the Fed hiking rates went down so dramatically, because we went from positive employment to slightly negative. Now, what's odd is the unemployment rate actually went down. And when you look at it, it just looks like the participation rate of people, looking for jobs actually dipped down a little bit. So that was kind of weird. So this is definitely something that's going to probably get revised. It'll be interesting to see how that happens and what the next month one is. But this is showing a little kink in the armor of the economy looking pretty good. So something to keep an eye on. All right, last month, what was the most important event of the month? Well, believe it or not, it was the bond market. Yes, the boring bond market. You see, it's very important for yields to stay low. That helps the economy because interest rates are like gravity. The higher the gravity, the more pressure there is against the economy. Lower gravity, obviously, better for the economy. And what we saw here is from July to the end of July, we had this pretty big spike in interest rates. This is the 10-year Treasury bond, and you can see that it surpassed where we were at the peak of oil and all the craziness with Iran and the geopolitical stuff. So what is going on here? So you could say, well, the memorandum of understanding kind of broke down. We're fighting again. Oil prices came back up. You can argue that that was pretty much everything. Some are saying that it was worse, and the fact that inflation's been going up, and he keeps saying that, you know, he wants to fight inflation, but they're not doing anything, right? They're just holding still, and his communication style is maybe a little less transparent than the former style of Powell. So they're throwing a little bit of a hissy fit there, maybe. I don't know. I think I'm going to attribute it more to what happened overseas in Japan. You see, Japan was selling treasuries so that they can buy the yen because the dollar had been going up so much against the yen. No country wants their currencies to go way down because that creates a lot of inflation. So they were actually selling a ton of treasuries. They own a lot of treasuries, and so they can convert that into cash and buy their yen. So what we saw is in those last few days of the month, we saw a pretty good spike right there in the 10-year treasury. I think a lot of that was really to do with the yen and not so much about this wash talk, because it turns out with the unemployment number coming down and not being really great at today, it turns out that the Fed probably did do the right thing, just staying put. Okay? And the other news that I would bring up is over the last few days, the yields have been coming back down as well. Maybe there's going to be some new peace deal. Maybe it was, probably a lot had to do with the unemployment report today. But we need to have yields more in the 4.5% range. If they start going back up into the 5% range, I think that could be a real bad headwind for the economy. All right, and for the last part of my outlook, I just wanted to reiterate what is going to keep this bull market going, because I am rather optimistic about the rest of the year. I think the market could continue to go up. I am always a little cautious, especially with the valuations of where we are right now with the market, but a lot of things still look pretty good. But what could keep it going? Well, a ceasefire would be tremendous. That's probably number one. That's why I put that on the top. A ceasefire, temporary or complete, of any kind, just a de-escalation of what's going on in Iran. And so that would be very important. Number two, earnings have continued to just rock. They've been great. I mean, we're talking about double-digit earnings. Some of the biggest earnings growth that we've seen since like after COVID. So I think the last quarter we saw 30 to 40% earnings growth. I mean, this is phenomenal. So if we can keep up that double-digit earnings growth, that would be great. The problem that we're seeing is that there's been a lot of spending on this AI infrastructure. They call it CapEx. So if we can get a little bit more reasonable in how we're spending there, I think the market would be very happy with that. Right now, it's a little concerned with how much is being spent there. So that's another thing to keep an eye on. And of course, like we just talked about, the yield's got to stop accelerating higher. If they can at least flatten out or slow down in their acceleration rate, or even better, go down a little bit because maybe inflation's starting to cool off, maybe the Strait of Hormuz is opening up again and oil prices drop. These would be the things that I'm going to be watching out for. as far as for the market to continue to go higher. If we don't get these things, these are going to be headwinds that are going to be tough for the market to overcome. All right, so here we are. What does this all mean? What are the implications? Well, we're still pretty neutral with the market. We are definitely leaning a little bit more on the bullish side, again, for stocks. So what we've been doing here in the last month or so is just continue to rebalance, taking advantage of the fact that yields are up quite a bit. We were just talking about that. Buying bonds when yields are higher is usually going to help the returns going forward of the bonds. And so we've been buying those bonds at attractive yields, selling the stocks at very attractive prices. So I think you do that over time, you're going to be pretty happy and you're going to be reducing risk along the way. But we're still leaning a little bit into the market, keeping a little bit of the commodities just in case for insurance. And so far, so good. So if you guys have any questions, please feel free to reach out. Let me know. And please feel free to share this video with your friends. I would really appreciate it. Thank you and God bless. Bye-bye.